The CNN Fear and Greed Index outputs a single number between 0 and 100. 0 means the market is in full panic. 100 means participants have apparently forgotten that markets go down. Most retail investors treat this number like a horoscope. That is a mistake. The index is a composite of 7 underlying signals: market momentum, stock price strength, stock price breadth, put and call options ratios, junk bond demand, market volatility via the VIX, and safe haven demand, measured by the spread between stock and treasury returns. Each of the 7 inputs is normalized and equally weighted. The composite score then gets bucketed into 5 sentiment categories: extreme fear, fear, neutral, greed, and extreme greed. Understanding what goes into the number matters more than the number itself. Treating the output as a single oracle while ignoring its 7 components is how retail investors consistently misuse a tool that was designed, in principle, to be useful. The index is a sentiment gauge, not a timing signal. That distinction is critical. The intended use case, and the academically defensible one, is contrarian. When the index is in extreme fear territory, historically below 20, markets have tended to be closer to a floor than a ceiling. When the index sits above 80, the inverse applies. During March 2020, the index hit 2. The S&P 500 bottomed shortly after. In November 2021, it touched 82 during peak meme stock euphoria. The subsequent drawdown in growth equities exceeded 30% in some sectors within 6 months. The problem is that extreme readings can persist. An index at 15 does not guarantee a bounce tomorrow, next week, or next month. What it does tell you is that the distribution of institutional and retail sentiment is skewed heavily toward fear, which has historically preceded mean reversion. Directional probability shifts, certainty does not arrive. There are 3 misreadings that appear consistently among retail participants. First, treating a single day's reading as actionable. The index can move 15 points in 48 hours based on a single CPI print. A snapshot is not a trend. You need to observe the directional trajectory over 5 to 10 trading sessions before drawing inferences. Second, ignoring the subcomponents. If the composite reads 35 but junk bond demand remains elevated and the VIX is subdued, the fear signal is being driven by put-call ratios spiking on short-dated options, which often reflects hedging activity rather than genuine liquidation panic. Those are different situations with different forward implications. Third, conflating sentiment with fundamentals. The index hitting extreme greed at 85 during a period of 15% earnings growth is contextually different from the same reading during a period of deteriorating margins and slowing revenue. The index has no balance sheet. You still need one. Let us look at what the data actually suggests. Using illustrative figures, grounded in documented market behavior. If you had purchased the S&P 500 index every time the fear and greed reading closed below 20 and held for 90 calendar days, your average forward return across the major instances from 2011 through 2023 would land in the range of 8 to 12%. If you had purchased every time the index closed above 80 under the same holding period, average forward returns compressed to roughly 1 to 3%, with significantly higher drawdown exposure in the interim. That is a meaningful asymmetry. However, note the word average. In 2015, an extreme fear reading of 8 was followed by an additional 11% decline before recovery. The signal improves outcomes in aggregate but does not eliminate adverse outcomes in sequence. This is why position sizing and entry staging matter as much as the signal itself. Edge is probabilistic, not deterministic. The Fear and Greed Index is most useful when it confirms what other signals are already suggesting. Used in isolation, it is an anecdote. Used in confluence, it becomes part of a thesis. Consider the following framework. If the index is below 25, and simultaneously the 200-day moving average of the S&P 500 is within 5% below current price, credit spreads are widening, but not yet blowing out, and the VIX is elevated but declining on a 5-day basis, that is a materially different setup than the index printing 25 inches isolation. You now have 4 independent data streams converging on the same directional hypothesis. Conversely, if the index is above 75, and you are observing tightening credit spreads, a flattening yield curve, and insider selling activity accelerating, You have a greed reading with multiple structural headwinds building beneath the surface. The index does not trade. You do. Build the discipline to require at least 3 confirming signals before acting on any single reading. The operationally correct way to use the Fear and Greed Index is not to generate buy or sell signals. It is to modulate position sizing. Here is a concrete framework. Establish a base equity allocation, call it 60% of your investable portfolio. When the index enters extreme fear below 20 and holds there for at least 5 consecutive sessions, you increase equity exposure by 10 to 15 percentage points. Staging entries over 2 to 3 weeks. When the index enters extreme greed above 80 for 5 or more consecutive sessions, you reduce equity exposure by a similar increment, rotating into short-duration treasuries or cash equivalents. You are not market timing. You are systematically buying slightly more when assets are statistically cheaper relative to sentiment, and slightly less when they are statistically expensive relative to sentiment. The edge is compounded over many cycles, not extracted from one bold call. This approach requires patience, a written process, and the willingness to look wrong in the short term while being correct in the medium term. The Fear and Greed Index is a living data point. Its utility is not retrospective. As of any given quarter, you should be tracking its 30-day trend, its subcomponent breakdown, and the degree to which it diverges from or confirms the macro backdrop you have independently assessed. The specific number matters less than the trajectory and the context. If the index is currently hovering in neutral around 50, that is not a resting point. It is a compression zone. Markets rarely stay neutral for long. The question to be asking is not where the index is today, but which direction is it more likely to resolve, and what is your predefined response to each scenario. Build that decision tree before the reading changes, not after. Reactive investors open their brokerage app when the index hits 12 and panic buy. Systematic investors already know exactly what they will do at 12, at 25, at 75, and at 88. The index gives you the inputs. The process is yours to build. Build it now.